How US debt levels impact Forex trading. The beginner's guide. Welcome to FX Titans. Today we are diving into a hot topic in the global economy: US debt levels. The United States is one of the largest economies in the world, and its debt has been making headlines. But how does this impact Forex trading? And more importantly, how can you take advantage of this trend as a beginner? Stick around for practical tips and real examples. First, let's understand what we mean by US debt. The government borrows money to fund programs, pay interest, and manage its operations. This borrowing is measured in trillions of dollars. Why does this matter to Forex? Because when debt level rise too high, it can weaken the US dollar, creating trading opportunities in major pairs like Euro USD or USD JPY. For instance, during the 2023 debt ceiling scandal, the dollar saw fluctuations as investors became uncertain about USD. When debt level rises, the government may need to print more money, which can lead to inflation. Higher inflation often weakens the dollar, making other currencies like the euro or yen stronger. As a trader, this means you can look for opportunities to short the USD or go long on pairs like Euro USD or Australian dollar/USD. And don't worry about analyzing all this yourself. Our Telegram group provides daily signals to guide you. As a beginner, you don't need to understand every detail about debt. Focus on the signals and strategies. For example, when debt news breaks, it's a good time to trade safe haven currencies like the yen or Swiss franc, as this often gains strength during uncertainty. Ready to trade smarter with the latest market trends? Join our free Telegram group for signals, mentoring, and live updates on global news. Don't forget to like this video, subscribe to FX Titans, and hit the bell icon so you never miss